Hey everyone, today we're diving into Implied Volatility Crush, also known as IVcrush. This is a scenario where implied volatility rapidly declines, leaving the option buyer with little to no gains on an option that might even be going in the option buyer's favorable direction. It can end in massive losses, so it's good to know how it works, how to avoid it, and how to take advantage of it. IVcrush starts when implied volatility is extremely high. This could happen from anticipated news on the corporate level, FDA approvals, or most commonly earnings announcements. Implied volatility could go up to 150%, 250%, or even higher. Let's give a standard call as an example. The stock is trading for $50. You buy one call with a strike price of $50, which is at the money, and that call costs you $300. At the time of purchase, implied volatility is 150%. Earnings is tomorrow, so the option chain is popping with tons of people trading both calls and puts. The delta is 0.30, the gamma is 0.05, the vega, which directly correlates to implied volatility, is 0.02, and the theta is negative 0.09. Now I'm just setting the scene so I can show you a theoretical scenario that will help decipher IVcrush. So our option buyer bought this call because he was speculating a positive outcome for the earnings report. Tomorrow comes and earnings is pretty good. The stock is up 4% and it is now trading for $52. Now looking at this from afar, you would think this guy made some money off of the option, but the sad thing is, implied volatility now goes from 150% down to 50%. Now he actually loses money on this trade because of the IVcrush, or the implied volatility decreasing by a huge amount. Let's take a look how. The stock went up 4% from $50 to $52. So let's break down the loss. So theoretically he earned $60 from delta, $5 from gamma, lost $9 from theta, and lost $200 because of vega. Now how did this happen? Well, notice the vega was 0.02. So this means every 1% change in implied volatility, the option price will increase or decrease by $2. Since the implied volatility went down, the option is losing $2 per percentage of decrease in implied volatility. The implied volatility went from 150% to 50%. This means that it decreased 100 percentage points, which ultimately means the option decreased by $2 times 100, which equals 200. So Mr. Option Buyer is now left with his call valued at $156. He purchased it for $300. A way to avoid this could be if you buy contracts before implied volatility starts to rise, which could be a week or a couple weeks before earnings, to avoid the inflated levels of implied volatility. A method you could use to take advantage of a situation like this, which I do sometimes, is to write option contracts, sell to open, when the IV is extremely high, and cover when IV goes back to relatively normal rates. In a case like this, I would write a contract for, let's say, $500. And the IV is at 200%. Now IV goes down to 100%, and the contract is worth, let's just say, $200. And since I'm the option seller, the goal is to have the contract decrease in value. So I just made $300 worth of profit. So now you know about implied volatility crush, also known as IVcrush. Hope this helped. Make sure you like, comment, and subscribe for more. See you in my next video.